estimate is that it's going to take 3 years. So basically, 2019 earnings of $165 on the S&P is what we're going to get in 2022. And that means that all else being equal, we shouldn't get back to peak stock prices for the same amount of time because, you're paying a multiple on those type of earnings. And, historically, it's been 10 quarters to get back to even, 2.5 years. And this is obviously far worse than you've had historically. And I don't think the market, or I don't think investors are thinking in terms of that. If you look at it on the horizon, there will be a point where we have no choice but to kind of recalibrate around those long-term numbers.
But there is
Mark,
still equities are such a better play than everything else. I mean, you've got a lower interest rate environment, so that will help support the multiple a little bit. And the markets do look ahead. So I think that even I do agree that we haven't incorporated the long road back that we face. But I do think that the discussion has shifted to where we're now focusing about how the economy is going to recover. And so folks are beginning to pull some of that improvement forward.
Well, but Mark, to that point, I mean, you got 80 S&P companies that have suspended guidance. Jonathan did a nice note on this morning on how analysts, how their models are biased given that giant hole in corporate guidance, at least when it comes to profitability. I mean, how are you filling that hole in your model?
Well, I don't have a model that looks at earnings in that way, but I will tell you that it's just the change in the direction of the discussion. So we're very early. We haven't started the recovery yet, but when you look at where the contraction is, the bulk of job losses are likely to occur in the months of April and May, and we're likely to see some incremental improvements in the economy beginning in June. Now, we're not going to get back. I think we're probably going to get back to 2/3 to 3/4 of the speed that we had previously. The summer might actually be pretty robust because typically flu viruses don't transmit as well in the summer. So hopefully this will behave similarly. In the summer, we may see some robust gains, but then we don't know what's going to happen in the fall. So there's heightened uncertainty. There's uncertainty about earnings. There's uncertainty about the direction of the disease. So I have a hard time justifying how quickly the market came back. But the one thing that I think has changed in a meaningful way is that the bulk of that immediate hit now seems to be behind us. We've seen jobless claims come down a little bit, and folks are beginning to focus a little bit on what the recovery is going to look like, and they're trying to find their spots in the market as to what's going to be advantaged and what's going to be disadvantaged.
If I can jump in and take the opposite side on this, I think that sometimes we confuse the direction of the virus with the direction of the economy. Clearly, the number of new cases and deaths is coming down, and hopefully it'll be down to a very low number in coming weeks. But if you look at what corporations do in terms of their spending behavior, CapEx spending after you've had a downturn, first, it just doesn't bounce back right away because companies are sitting with lots of spare capacity. Advertise as much, either consumer brands, because they need to repair their balance sheets, and the ad spending tends to be the money that goes towards tech companies that have ad-based business models. And so you have retailers that don't know whether they want to take inventory going forward for the next couple of quarters to the extent that they can address that, because they don't know if their malls are going to open. So yes, hopefully we'll be out of our homes and people will be healthy, but this is going to take longer. So this belief that we have that we're going to get this incredibly sharp V-shaped bounce in the third quarter during a period where things are going to still be dislocated. And even if the health issues are behind us, recessions still take a period of time to work through the system. Credit needs to be repaired, and that process, history says, is a bit longer than we all think it is.
I don't disagree with any of that.
Right, well, this is no ordinary recession.
I think that my sense is, though, that we are going to get a bounce in the third quarter, and I've been warning people that it may look like a V because we came down sharply and we're going to recover sharply. It's going to be a double-digit third quarter GDP number. But after that, it's going to look more like the Nike swoosh that we had in the last two recoveries, where it's going to take us a long time to get back to where we were previously. And I have no doubt that we're going to see huge dislocations in business fixed investment because we've got idle capacity. But we are going to see when we go from having restaurants shut, 90% of restaurants shut, 100% of movie theaters shut, and we go to 60%, there's going to be some improvement, and we're going to go to 50%. And so we are going to see some incremental improvements in the economy. I think that the market's going to have a tough time pricing that. And my general sense, I'm not a stock market guy, I'm an economist, but my general sense is that we may have gotten a little bit ahead of that because I really have a hard time seeing how we get past 3/4 speed as to where we were previously. And there's going to be income loss in the economy. The fiscal policy, the monetary policy have done a good job of plugging some of that immediate loss to income, but they can't replace it. There's no way that we have enough resources to replace the hit to income. And so that's going to put a governor on economic growth going forward that'll last at least through 2021. 2022 is too far out there for me to think about right now.
No, it's a really good debate, guys, and I think it's the one that every single person, every single investor is having right now. Jonathan, what's the upshot, though? If you say the market's too expensive, sounds like you're worried about energy, you're worried about the banks, I guess, on credit losses. Where should investors go right now for some safety or for some positioning?
Yeah, I mean, if we look at what's likely to happen from an earnings perspective, the cyclical parts of the market. So this is the discretionary sector. These are retailers and autos and home builders and the like. If you take out the internet retailers, they're trending right now as if they're going to have zero profit growth in the second quarter. The same thing for the industrial sectors, materials and energy. And I think that they're going to continue to feel a lot of pain. Tech, as much as they're going to feel some pain, they're holding up substantially better than other areas of the economy and areas that are non-cyclical. These are staples and many healthcare companies and the like. So I think it's a script that we've seen now for quite a while, which is it's growth companies, it's stable defensive names, and staying away from cyclicals, which would include the banks. Is still the playbook. The only one area within the non-cyclical group that I think probably has a harder time are REITs. Those are areas where people are not paying their rents in many cases, and I think, and they're not all the same. Many of those names I think are going to be under pressure, even though traditionally they're a defensive group.
Jonathan, Mark, thank you both. Good discussion.
Thanks.
Thank you.
Dow down 350 here. All 11 sectors are lower to start the week. Later on in the hour, do not miss the CEO of Shake Shack returning its PPP loan. We'll be right back. Stay with us.
For the first time ever, we're gathered together in Singapore to bring you Global Squawk Box live.
I want to work with the best and I want to learn from the best.
The depth of coverage, the depth of expertise, they've clearly done their homework on the topic, not just the people.
Welcome to ETX Capital, a trading platform built on experience and trust. For over 50 years, we've given our customers stability and personalized services. London-based, we have a UK focus combined with a global approach. Ours is a personal, tailor-made service. Stay on top of the markets with ETX Capital. the award-winning personal trading platform.
Good morning, everybody.
Squawk Box, covering the 3 R's on the latest readiness, relief, and record-setting results impacting the nation. Squawk Box on CNBC.
Welcome back. Let's get straight to our ETF spotlight. We are watching the energy sector today. Ticker XLE under pressure with U.S. prices plunging for the price of oil this morning. Our Brian Sullivan has more color on this massive drop we are seeing in crude. Morning, Brian.
Hey, good morning. Well, it's rolled over a bit. I mean, you got to remember this May contract, and I don't want to get all wonky in this contract weeds, but the May contract is flipping over. In fact, on my screens, I'm already seeing $23. So there's the current month contract, but again, it expires tomorrow. It's at 1090, down 40%. There's some funky stuff, guys, going on with that as far as a lot of heavy shorts. That's the May delivery. Really look at June, which is Michael Jordan, not number 10. It's a 23. You got 28 for July as well. I'm not saying it's good. Nobody is. But I will say this. If you put up the XOP or any of the big cap oil stocks, they're down a couple percent. But they're not collapsing, guys. So as I just tweeted out, the action in oil stocks is not entirely horrible. No new oil stocks are making multi-year lows or a 52-week low today. Even with that contract down 40%, there are 0 new 52-week lows being made. So if you wanted to find a little silver lining on a Monday, we all need it, right? You could say the oil stocks are not collapsing like that front month contract is. More oil, by the way, is on the way from the Middle East. We should be getting a few million more barrels by shipload in the next couple weeks because we need that.
Yeah, right. I mean, there is a lot of talk, Brian, about surging inventories and just running out of room to store all of this crude. What have you heard on that?
You got a closet or a bathtub or something, Sarah? I mean, because an oil producer might ask to put a barrel in there. If you do, and I'm only being partially facetious. Everybody's asking, when are we going to run out of storage? I don't know. Nobody knows. I'll tell you, people are finding creative new ways to store things. All the ships off sea, of course, we know that. We've been talking about these tanker rates. A lot of the tanker stocks have done good because you're paying a lot of money to basically, here, fill your ship up with my oil and just anchor it off the coast of Galveston for an indeterminate amount of time until prices go up and the ship owner collects the rent on that. That's what's been happening. The irony about oil, if you ever really think about it, Sarah, is kind of funny. We pay to extract it from the ground, and now we're theoretically paying to put it back in the ground into the Strategic Petroleum Reserve and other places. I think the best case might be to leave it in the ground, but that's not what's happening.
No, all of it putting pressure on crude. WTI $10.81, down 41%, though. As Brian noted, energy stocks are lower, but nothing severe like that, down about 2 to 3% as a group. The entire market's down 1% for the S&P. We're going to take a quick commercial break. Stay with us here on CNBC.
Throughout history, humankind has prevailed in our darkest moments, coming together to face the very thing that would extinguish our light. This is not one of those moments at all. This is a moment for pretty much the opposite. For hiding, for laying low. Napping is also good. Saving humankind by really, really not getting near it. Where playing games, staring at screens, staring at anything, all are the stuff of heroes. Every generation has its moment where individual sacrifice makes way for the good of those who'll come after. A higher purpose. This one is ours.
Welcome back to Squawk on the Street. Psychology plays an important role in investing and spending all the time, but particularly in uncertain times like these. For more on that, let's discuss. And we're joined by New York Times columnist Jim Stewart, of course, and behavioral spending expert Jeff Kreisler. Jim, I'll start with you. You've been having that mantra for a long time when it comes to investing. Just stay the course. Still very hard to do in times like this, isn't it?
Oh, it's unbelievably hard because I've just been experiencing all over again. I guess one of the reasons is that, I guess it's good. We only go through these extraordinary, crises on relatively rare occasions. It's been over 10 years now since the financial crisis, and that's a long time, to try to remember some of those lessons. But the emotions are the same. We're hardwired to react in a certain way, and when there's a crisis, when fear is sweeping everybody we know, the impulse is to freeze up, which is what's happened to me, and it really took a tremendous amount of self-discipline to try to get over that and do some investing, which I did manage to do, but I'm telling you, it was really, really hard.
Yeah, Jeff, when it comes to really, really hard, I would imagine it's also tough right now to figure out if you're potentially going to lose your job, or if you're concerned about your company that you're working for, or your salary. Just hard in general to understand what your spending habit should be. What's the psychology around that right now in terms of the average consumer? What are they doing and what are they doing wrong?
Well, you're right that a lot of our financial decisions that are often irrational are about stress and uncertainty, and that is really heightened right now. So there's a lot of interesting research that shows under these moments of stress and uncertainty, we can think of financial decision making that's bad and
of areas, and we've added massive cash and liquidity to 175 million Americans. I think that's a good beginning.
Larry, you've done a lot, but you'll understand that in moments like this, sometimes these conversations can get a little bit silly, and this isn't a got you moment. I've got a very sophisticated audience. In fact, I think I'm lucky to have the most sophisticated audience on the planet. You yourself have been around for decades. We both know that US companies pay the tariffs. The president keeps saying that China's paying the tariffs. Now, yes, of course, there is some economic fallout from all of this, but at the end of the day, by definition, the US importing company pays the tariffs. That's why you're deferring these payments. Why do we do these silly things, Larry? Can't we just move on from this? Can't the president just start saying who's actually paying the tariffs? It's US importers.
Well, look, Jonathan, that's a long conversation, but I will respond to your initial
Well,
point.
I understand you don't want to fall out with the president, but you must take it from my perspective that I know you know. We know, everyone watching this knows.
I have, from the very beginning, said that there would be some impact on the U.S. economy, albeit minimal. I don't think that was a big issue ever. The economy was booming in January and February, okay? Let's not forget that. I would say this, yes, tariffs are paid by the companies importing, yes, the U.S. companies, with a de minimis impact, frankly, on consumers, as evidenced by the strong economy. However, I will, and I said this very early in the game, okay? Now, I will say, in economic terms, with respect to China, if you're talking about China, a couple things, Jonathan, okay? They got hurt. They had to cut prices. They had to lower their currency. They had to take shrinking profit margins. Their economy was damaged enormously. And at the end of the day, President Trump's policies on tariffs and trade with China produced a very good Phase 1 trade agreement. Let's not forget that. It seems like that was 1,000 years ago, but it was really just a couple of months ago. A very good Phase 1. To me, the benefits of getting that trade agreement will far outweigh any economic costs, which, frankly, I'll say it again. You go back to January and February this past year, GDP was growing at better than 3%. So let's not fight that
Larry,
battle.
I've got to jump in, I'm afraid, because we're going to hit the break. Larry, always great to catch up with you, sir. From the White House, this is Bloomberg.
As someone with hearing loss, I know what a confusing and
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's always won in a lot of ways. Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
London, I'm Guy Johnson. Bonnie Quinn, of course, over in New York. This is Bloomberg Markets. Let's get more insights onto what is happening with the markets and the economy and the relationship between the two. We're joined now by Mona Mahajan, Allianz US investment strategist. Mona, thanks for taking the time to join us. Look, Larry Kudlow just speaking there to John Ferro, trying to put a positive spin on what is happening with the reopening of the economy. Yet I've got an oil price that is cratering, and I've got a bond market that is telling me that any recovery is going to be very, very bumpy. Yet equity markets continue, until this morning at least, to do very, very well. What are you reading into the relationship between markets and the economy right now?
Yeah, thanks, Guy, for having me. And look, it's been an amazing run, actually, in some ways, in the S&P. We're now off about 28% from the March 23rd lows. But at this point, we'd say the risk-reward here doesn't seem as favorable. When we think about a reopening of the economy, there is uncertainty that looms. What does a reopening look like now that unemployment has spiked close to 18%? What will a U.S. consumer look like now that they're more cautious as they reemerge? Keep in mind the economy that Mr. Kudlow was referring to prior to the crisis had a 3.5% unemployment rate. And in the U.S., consumption makes up about 70% of the economy. Unlike economies like China or even Germany, where manufacturing is a driver, in the U.S., it's really the consumer, and in many cases, the consumer who works at a small business, which we now know the fate of that story as well. What we will say is that, now that we've reached these 2,800 levels, to us, we don't think that we necessarily retest the lows of March 23rd of 2,200. Could we get back down to 2,400 to 2,600 levels, about 10 to 15% downside? Absolutely. But we do think that bottoming process is an opportunity for investors to really position themselves for a post-COVID world.
How are we going to know what that world looks like? We're starting in earnest, basically, the reporting season this week. I think it's nearly 100 companies now out of the S&P. Let's call it 20% of the S&P have withdrawn guidance. A bunch of other companies are not really going to give us guidance that is that reliable. The companies don't know what that world is going to look like. To be honest, the politicians don't really know either, because reopening the economy is going to be very difficult. We don't have the testing in place yet. How do we know to make kind of pragmatic calls about the kind of levels you're talking about without that kind of information?
Yeah, look, from an earnings perspective, the estimates have actually come in line more so with reality than they had in the past. We're now looking at, according to FactSet at least, earnings declines in Q2 of about negative 27%, and on a year-on-year basis down about negative 15%. That to us reflects a little bit more reality than the flat or even positive numbers we had seen early on. To your point of a post-COVID world, there are certainly some secular themes that we are seeing emerge that could give clues on how to invest. Within the technology space, clearly we're going to see more demand for Wi-Fi or 5G services. Companies are clearly going to need cloud computing and cybersecurity solutions. Within healthcare, the rise of telemedicine, the rise of on-demand testing and medical devices, pharmaceuticals that will be important in vaccination and therapy development. And then, of course, in online retail, which we've already seen a secular decline in the brick-and-mortar space. But this convergence to the Amazons of the world, to online retail and online grocery, clearly some winners emerging there as well. So there are stay-at-home themes that we think have secular legs in this environment. The other part of the complex that we're looking at is those companies that were priced to distressed levels and may actually emerge after this is all over. Think airlines, for example. At some point, we will need to travel again. And so that could be an area that could emerge as interesting. We're still advocating what we call a barbell approach. So what I just mentioned probably falls on the risk spectrum of that barbell. And then you have your defensive spectrum, which includes still areas like treasuries, which has been the flight to safety, gold, and then really high-quality investment-grade bonds, which are now being backed by the Federal Reserve. So some themes to think about as we move forward.
Mona, how much is the stock market indicative of the real economy and its performance into the future here?
Yeah, it's a great question. Look, the market tends to be forward-looking, but in this case, we think we might have come too far too fast. What I will say is the sector breakdown, if you take one level or look one level deeper in the S&P, does reflect a little bit more reality. The leadership that has emerged, and we talked about healthcare and technology, now the two top performing sectors within the S&P, consumer staples at number 3, and that includes the areas like the Walmarts and Costco's and Amazons of the world. At the bottom of the sector list is really your energy, financials, industrials complex, and we see what's happening in the energy space, very much reflected in the market. So I think when you dig one layer deeper, you do get a reflection of actually what's happening in the economy. We'll also say this could be, an active or stock pickers market here. You really may not want to own an index or passive instrument that can expose you to the underperformers or even the defaulters in this type of market. You really do want to position yourself, make some active bets on how to position and through the crisis and as you reemerge.
Where does this energy story play out for the producers and the E&P companies and the servicers, Mona?
Yeah, like we've been talking about, the oil complex is been hit dramatically. We not only have a supply issue, you have a demand destruction in many ways. The deal between the OPEC Plus and the G20 last week to reduce capacity by the 9.7 million barrels per day was a good start, but our analysis shows that the demand destruction is closer to about 30 million barrels per day, so nowhere near the amount of reduction in supply to match the amount of demand destruction, which is why we're seeing oil prices continue to crater here, WTI close to the $12 range. As we kind of stabilize and emerge, we do think there will be companies that really have to shut down and go out of business with oil at these levels. Ultimately, oil is an industry that we will need, and there will be either a supply consolidation or some of the governments will have to step in and really kind of support some of their businesses and markets in this energy complex. But in the near term, we expect oil prices to remain soft until we really get a stabilization either on the supply side or the demand side.
Mona, can I just circle back to what you were saying on tech? I'm really curious about this leadership that we're seeing in tech and how sustainable it ultimately is. I appreciate that some of these companies have sizable balance sheets. Balance sheets clearly not an issue. Yet if you look at Amazon, clearly Amazon's going to end up having to pay its people more as a result of what is happening here. That pressure is going to be absolutely immense. And then I look at Facebook and I look at Google, and they make a ton of money off advertising. And I'm struggling to see where those ad dollars are ultimately going to come from if the rest of the economy is looking as stressed as it is right now. Are people really going to want to pay up for advertising or certainly spend as much on advertising as they were before?
Yeah, absolutely fair points there. I think within the tech complex, you have to be pretty selective as well. I think the Amazon trend is here to stay, and despite the fact that they may be incurring larger labor costs, that story has secular legs not only in 2020, but really for the next 5 or 10 years. So that's a long-term secular theme. To your point about the advertising complex that are really, the revenue drivers for Facebook or Google type models, that is going to be a little bit more cyclical. So you're going to have to think about where we are in that cycle. And right now we're towards recessionary levels. So I do think you have to be cautious as you kind of navigate technology itself. It is interesting, within the 3 tech subsectors, software, semis, and hardware, software is now positive year to date. Semis and hardware is still negative, but something to think about. The risk rewards, you may want to wait a little bit until we get better valuations across the board here. But I do think at some point it's important to get involved as we move forward and reemerge from this crisis.
All right, Mona, thank you for your time today. That is Mona Mahajan, Allianz Global Investors Senior U.S. Investment Strategist. Let's check the latest headlines now surrounding the coronavirus pandemic, and we'll get to Viviana Hurtado for that.
Yeah, Bonnie, the coronavirus contagion appears to be slowing in some areas. Let's begin in Europe. In Germany, the first wave of openings today, small shops, that is. Schools may resume soon. Still, Chancellor Angela Merkel is warning of a delicate balance between easing restrictions and preventing a flare-up of COVID-19. That is also the concern in the UK. And hard-hit Spain, it's seen a leveling off of new coronavirus cases and deaths as the strict lockdown there continues. And this year, Spain's economy could contract by more than 12% in a worst-case scenario. This is according to the Iberian nation's central bank. Now, if we were to touch in Asia, in Singapore, daily infections there soaring, topping 1,000. But in Malaysia, a different story. Cases there are slowing. And here in the U.S., the country weighing phases in which the economy can be restarted region by region. But many of these proposals for business and society depend on widespread testing and contact tracing. That might not be available until September. Meantime, therapies are being tested, as is a race for a vaccine ongoing right now. Trials in humans and approval could be months away. And so that's really focusing attention on antibody treatments like Regeneron's drug cocktail. It neutralizes the virus's spike that latch on to lung and throat cells. This could be tested in humans in the summer and could be given to patients in the fall. It's just one of the therapies that are being called hope in a drug cocktail. This is Bloomberg.
This is Bloomberg Markets. I'm Guy Johnson. Coming up on Balance of Power today, we are going to be speaking to the UPS CEO, David Abney. This is Bloomberg.
Live from New York, I'm Bonnie Quinn, along with Guy Johnson in London. This is Bloomberg Markets. It is time now for our Stock of the Hour with Dave Wilson.
Well, Bonnie, I'm here to talk about DuPont. Now, this is a company that's about 2 weeks away from reporting its first quarter results. They actually gave some preliminary numbers that suggested their adjusted profit beat analyst average estimate in the Bloomberg survey. But now it's all about cash as opposed to earnings, given what's happened as a result of the coronavirus. So the bigger story here is that they've lined up $3 billion in financing for the next year, $1 billion in the form of revolving credit, think of it as a corporate charge card, and $2 billion that would cover the cost of debt maturing in November. Now, we're talking about the possibility maybe that piece of it, the $2 billion, gets replaced by bond sales down the line. Nonetheless, they're putting themselves in a position to basically get through the next year because they have $7.3 billion in cash coming from a sale of their nutrition business to International Flavors and Fragrances. You're talking about a $26 billion deal in total that they expect to complete in the first quarter of next year. So you have to be able to get through the next 12 months and have enough cash on hand. And actually, the revolving credit was due to expire in June, was only going to be $750 million. They managed to renew that and increase it. So that's a plus there. Now, they're doing other things as well, withdrawing their full-year forecast like a whole lot of other companies done at this point, delaying some capital spending, idling some plants that serve the auto industry because that's been a particular area of weakness for the business. No, you put it all together, and there is so much focus on cash at this point that the idea that DuPont lined up some more financing, put themselves in a better position when it comes to cash, is pushing the shares higher on a day when most stocks are down.
Interesting stuff, Dave. Thanks very much indeed. Dave Wilson with our stock of the hour. Okay, Instagram co-founder Kevin Systrom left Facebook back in late 2018, this after clashing, of course, with CEO Mark Zuckerberg. He's now on to his next acts, introducing a website that gives live, state-by-state updates on the spread of COVID-19. Bloomberg's Emily Chang spoke to him exclusively about this new website.
The whole idea here is that there's this number called the effective reproduction rate. And it basically means how many people get infected per person who is currently infected. If that number is less than 1, then the infection's under control. If it's over 1, it means that it's growing out of control. So we're trying to take what is a complex topic and boil it down to a simple number that anyone can view from their home just by visiting RT.live. And that's our hope, is to make it simple for everyone.
Instagram's growth was the epitome of viral in the online sense. What are you applying here that you learned from Instagram? Obviously, you have some unique insights into how we all socialize, and how does that apply to the model that we're seeing?
Well, I think there are two parts here. First, I want to say this website is simply the productionization, if I could call it that, of a notebook that I published and a model that I published. The idea was just that you could access it without having to press refresh, every day on the model. Separately, the viral growth that I saw at Instagram, I think, compares to the science of viral growth in general. Now, there are vast differences between an actual virus and the growth of a company, but they use similar math. And by using that similar math on this actual virus, you can actually come to some really interesting conclusions, including estimating this number R that we're talking about that explains how fast the virus is growing.
So explain to us Luddites then, how much worse is this going to get? And how much worse will it get before it gets better?
Now, here's the really interesting part about that question, is that you can't answer that question in general. Often you'll try to find people give a very, broad summary at the highest level across either the world, across a region or a country. But it turns out that this virus is very local, that Louisiana may be doing far better than Massachusetts, might be doing far better than, Maine. You have to ask what's happening locally. And here at this website, RT.live, we're basically breaking that down on a state level so that you can see what's happening around you. So I can't answer specifically when this gets better, but what I can do is give you effectively radar into seeing how it's going currently where you live.
Well, you do get really granular state by state. So let's take New York, for example, and maybe California, because we're both here. And I want to know, if you look at those two states, which have had vastly different kinds of outbreaks and different responses, what do you see?
Well, what's super interesting about those two states are that, number one, they've gone through a transformation and a lockdown. So you can actually see R used to be something like 2 or 3, meaning for every person that got sick, they would make 2 or 3 other people sick. And that's the reason why a lockdown is so important. And after the lockdown, you see the effective R number come down. And it comes down as we all begin to social distance, as we stop going to school, as we stop going to the workplace. as we stop shaking hands, as we start wearing masks, that the R number comes down. But what's super interesting is as we begin to become a little bit more lax, as we begin to open certain sectors of the economy back up, the question is going to be, what happens to that number? Does it go back above 1? And I think that's why this dashboard is so important, because it gives you a live insight into the effects of the choices we all make. And I don't know exactly what's going to happen, but I'll be watching the dashboard just as closely as you will.
Now, you correctly predicted that the U.S. would have 10,000 cases by March 19th. Meantime, you also point out you're not an epidemiologist. You have said you're showing this to policymakers. Who have you showed this to? How have they responded? Has anyone from the White House reached out?
Well, I have sent it out broadly, mostly because I hope that people take the concepts largely into the work they're doing, not necessarily the conclusions that I'm making. Because I'm one person, and the math that I run is specific on the data that I'm using, and there are a bunch of different sources. But the idea that we can manage our country or a state on this idea of an effective reproduction number, basically that's the thing that I want people to understand. And if you watched Governor Cuomo's address yesterday, he got deep into the idea of this effective R number and the idea that we can watch R as we start to make changes and as New York starts to open up again. And it can be that gauge that allows us to decide what to do.
And that was Instagram co-founder Kevin Systrom. This is Bloomberg.
From London, I'm Guy Johnson. Bonnie Quinn over in New York. This is Bloomberg Markets. Bonnie, let's talk a little bit about what's happening with the crude market. It's time for Futures in Focus. Todd Colvin of Ambrosino Brothers joining us now. Todd, I've got WTI crude front months trading at $10 a barrel. What's the downside here?
Hey, good question. We went home on Friday. The spot was trading at around $18, and things come in, and there's a lot of change. And when we talk about oil prices going negative, you're adding the production and storage costs together. We're already seeing that. It seems very, very hard to visualize, having an oil producer pay you to hold their oil, but that's kind of the level we're at now. There's some small downside, and there's some big upside, but big upside is very unclear because big upside doesn't come until the global and domestic economies open up again. And right now, we're talking about rolling out very slowly, and oil prices don't want slow growth. They want immediate satisfaction. Right now, they're not getting that. It's being reflected in prices.
Absolutely. Clearly, one of the factors here is, as you say, there just simply isn't the storage in the pipes or in the tanks to be able to take some of the crude that is coming through. At what point do those tanks kind of really get full? At what point do those pipes get completely full? Is there a crunch point coming?
Well, there is, but we're already seeing producers pull back. We had the OPEC Plus meeting that, we're going to back off of, somewhere between 9 to 10, whatever the number was in billions of barrels, millions of barrels a day. Now you're going to start to see even greater pullbacks in production because, like you said, there's just nowhere to put it. And at this point, when the U.S. is going to probably try and buy as much as they can at these levels for storage. Why wouldn't you? If you can create storage, this is the opportunity. This is the zero interest rate environment for oil. So why wouldn't you, as a sovereign, be buying as much as you can and finding a place to put it for future use? So there might be some buyers out there at these levels. It's just a matter of finding a place to put it.
How much of the shale patch do you think goes out of business as a result of this? Like, how much kind of forced capacity outage is going to result?
Well, we've already seen a significant slowdown in the shale. Clearly, once we got down below 30. I think you're really playing even Steven on production versus profit when you get below 30, even maybe even a little higher than that. So yeah, you're going to see a significant slowdown. And now they are ready to go when things come back. But even if you look out at the forward guidance of futures prices in oil, we're talking $35 a barrel. We're not up to $50 or $60 a barrel anytime in the near future. So that's where they need to be. So it's going to be a significant time before the shale producers are back online the way they were.
Todd, as we've been speaking, oil falling to its lowest level since April 1986 in New York. Todd Colvin of Ambrosino Brothers, thank you very much indeed. Vonnie.
Well, coming up, crude crunch. This conversation continues as oil price pressures come under serious pressure. We're going to be speaking with Paul Sankey of Mizuho about how low we can go. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
when opportunity knocks at the door, don't say, blimey, I've still got my pyjamas on. Say yes to stuff and it will take you in interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, joining us on Leaders with LACWA.
Live from London, I'm Guy Johnson. Bonnie Quinn's over in New York. You're now watching the countdown to the European close right here on Bloomberg Markets. Bonnie, equity markets around the world under a little bit of pressure. Let's show you what's happening here in Europe, because actually, relative to other markets, it's not actually that bad. In terms of the picture, and you're looking at crude on the screen at the moment, that's probably the dominating factor at the moment. We've got Brent crude only down by 5% here in the global benchmark, only down 5%. New York crude trading down by 40-odd%. But in terms of equity markets, we're seeing a flatter story. We are seeing a more defensive bias in terms of the makeup of the market. In terms of the picture, you've got the Euro Stoxx 50 actually in positive territory now. FTSE 100 up by 0.2%. The pound's under a little bit of pressure as we watch Boris Johnson talk about his fears surrounding a second wave. And we're watching the Bund BTP spread broaden out a little bit as well. As you can see, we're up by 13 basis points. But as you can see, the pound down by 2 basis points. Big meeting on Thursday, Vonnie, in terms of the EU. And there's going to be clashes about whether or not we're going to see joint debt issuance. Vonnie.
Yeah, we'll be speaking to Maria Tadeo about that in just a few minutes. Here in the US, we're seeing equities lower too, dragged lower by oil, which was down almost 40% at one point and is back there again now. We are trading at $10.85 for a barrel of WTI. It is really insane levels of trading. Mind you, the contract expires tomorrow. The VIX trading just above 40. As you can see, the 10-year yield at 62 basis points. Just one stock to point out, United Airlines. Obviously, the airline's having a terrible time of it. It's talking about total revenue in the first quarter down 17% and looking at a $2.1 billion loss. It's going to get $5 billion through the U.S. payroll protection program, but really it's just one of the airlines having a really difficult time of it. Right now, though, it's home builders that are the worst performers in the S&P 500.
Vonnie, let's get back to that board we were showing you right at the top of the program. The price of WTI crude, as you were just mentioning, trading $10 a barrel. Now, that's the lowest level in over 2 decades, back in 1986 prices. Let's get some analysis on what happens next. Paul Sankey, Mizuho Securities Senior Oil and Gas Analyst, joining us now on the line. Paul, just give us your sense of where we are and where we're going. Are the lows in for WTI crude, at least in the short term?
I think they are for this week, because obviously you're going to roll, as Vonnie mentioned, you're going to roll the contract tomorrow and it'll pop up to closer to $20 a barrel. But I do feel that we'll go through this all over again at the end of the month, in a month's time. And that's actually a tougher setup, because at that point, inventories will be very much close to the top of the tank, and at the same time we'll have the Saudi surge in production hitting the Gulf Coast of the U.S. At the same time, we don't see here in New York the potential for a significant end to the lockdown for at least a good couple of weeks, I would say. So I think it's going to be very painful today and tomorrow. We'll roll forward a month, and then we'll do it all again in a month, back down potentially to these lows again.
Okay. We've got a Texas Railroad Commission meeting that's going to take place tomorrow. Are we going to see any action taken in the United States to at least have a structured approach to dealing with the excess supply?
I doubt it. I mean, the Commission had a long hearing with numerous speakers, and the most impressive and influential speakers were very opposed to proration. Proration being the Railroad Commission cutting volumes across producers in Texas, as you know, it goes against everything that Texas stands for in terms of free market, and is really seen as by many of the players as being certain companies wanting to avoid lease obligations or pipeline obligations, and therefore being able to call force majeure. That hasn't really been confirmed, but on balance, most people don't want the cuts to occur because they're happening anyway. The interesting thing here is, as you can see from the spot price of WTI, the physical market is going to force shut-ins by millions of barrels a day. And that's essentially what we're watching unfold here in real time.
So, Paul, a few days ago the president was talking about paying producers to keep oil in the ground. Where does that go, and does it protect many of them?
Well, that one's another head-scratcher. I mean, one of the things we've said about oil is that the cycle is bad enough as it is. It's always been a boom-bust business. But then the government gets involved at just the wrong moment. There hasn't been much more clarity on what that pay not to produce plan would be. It was mooted by the Department of Energy. And again, it's very difficult to see that people will really prove that in places like Texas, which is so oriented towards free market. But you're right to highlight it, Bonnie. It was yet another head-scratcher for us, trying to just follow the market in logical terms and then find these very illogical government interventions that really distort the market even further. The bottom line is that if you check Google Mobility or Apple Mobility, you'll see that global mobility is down by 50% to 85% in almost every country in the world, and that's the problem. And until we get through the demand side, we're going to remain under very severe pressure in oil prices. We, as you probably know, called for negative prices potentially a couple of months ago, and we're not far off getting there. As you know, many grades are actually pricing right down towards zero.
Yeah, it's phenomenal. And you actually pull out the mobility for the various countries. I mean, India is down 82%, the UK down 65%, just a couple of examples there. And I suppose no surprise, right, because cars aren't on the roads. Some trucks are still, but maybe even the truck routes are not as busy as they were at the very beginning of the lockdown, at least. So, Paul, when this starts to come back, when people do start to be able to drive, visit each other again and so on, I mean, do we see a ramping up of demand pretty quickly?
We think so. The regressions we run show you that whilst there are issues with efficiency in gasoline, there's a few Tesla sales, barely really relevant in the grand scheme of things. Employment is very important, obviously, and that's a disaster. But by far the single biggest factor historically in gasoline demand in the U.S. is actually price. And we think that the very low prices you're seeing here, which, for example, you saw in the global financial crisis, actually demand is extremely robust because people really do consume more gasoline at very low prices in the U.S. It's a clear regression. And we're optimistic that actually the second half is going to be great for refiners. The overhang of inventory and spare capacity that we're getting from all of this makes you very concerned about crude oil prices for at least another year. But the potential for very wide refining margins in the second half, I think, is pretty clear.
Paul, what is going on with particularly U.S. refineries right now? How much output is there? What is the capacity to turn more production on? What is the storage looking like for distillates? I'm curious that we can't do more with the crude that is sitting around in tanks and pipelines, and maybe that get that ready for some of the demand that we are going to see further down the road.
Well, in general terms, the way the oil market works is, firstly, it doesn't store much oil at all relative to consumption. So inventories structurally are very tight. That's why you're having such a cataclysmic market here, because really the industry operates on producing a barrel and selling a barrel and typically tries to store as little as possible. Secondly, you don't tend to store products because actually they kind of go off. The way you store oil is in the form of crude, so you don't refine it unless you need it. U.S. refining capacity utilization has fallen down towards 70% utilization. It's an interesting conundrum because actually for individual refineries it's hard to run much below 60% utilization to maintain pressure and safety. You actually have to turn the refinery off. So they're probably running more than they may want to on average in total. But ultimately, inventories, there is still space in inventories. That's what's interesting, both in product and actually still somewhat in crude. But ultimately, the way you manage the excess supply is to firstly store the crude, most importantly, and secondly, then not produce. And what we see happening is over the next month, inventories completely filling, absolutely, over the next, let's say 6 weeks. And then the enforced shut-ins, which haven't really quite happened yet. We've seen economic shut-ins and preemptive shut-ins, but just the sheer, you cannot produce this oil anymore, we think will represent about 1.5 million barrels a day of enforced shutdowns in the U.S. alone.
We've got a question in from a viewer, which is interesting. Presumably, U.S. refineries are going to benefit more with the lower price in the United States versus those that take crude on a Brent contract. Can you kind of walk me through how it will work if you take a look at what's happening in the United States, continental United States, and what is happening elsewhere in the world, particularly some of the European refineries around Rotterdam?
Yeah, your viewer is exactly right. Firstly, the gasoline price trades globally. So essentially, the margin is set by the price of crude relative to a global price of gasoline. The gasoline is highly fungible. That is to say, the U.S. gasoline is as good as European gasoline, is as good as Asian gasoline. So the key difference you get is between crude prices. And as your viewer is rightly pointing out, U.S. crude prices will be significantly discounted relative to global, all keeping in mind that paper prices, that is to say the paper traded prices, are well above the physical. And secondly, that the market crudes that we use, WTI, Brent, typically are light sweet, and those are not actually the most favored barrels for refiners. They prefer the medium sours, the Saudi type crude, just in terms of how their refineries are set up. But even then, when you add it all together, simply if Brent is significantly higher than WTI, you accrue pretty much the difference per barrel as a margin to the U.S. refiner. And that is has been a significant part of the bull case for U.S. refining over the past 10 years since U.S. production growth started so aggressively around 2010.
Paul, we have to leave it there, but thank you for joining us this morning. Paul Sankey of Mizuho Securities there with us. Let's check global markets now with a deep dive. Here's Abigail Doolittle.
Vani, at this point, we do have stocks looking past, to some degree, that plunge in oil that you all were just talking about. If we take a look at what's happening here in the U.S. and in Europe, stocks well off the lows, even higher. Take a look at this. The S&P 500 down just 0.6%. I say just because at the lows down about 2%, both crude oil and stocks, risk assets, so often they'll trade in a similar fashion, especially that picture that crude oil is giving around the demand picture, global growth really slowing. You would think that would hurt stocks, but again, the S&P 500 off of its lows. And in Europe, we actually are looking at small gains. The emerging market's about flat. So net, not a lot of action happening at this point for stocks as investors continue to try to sort through the clues. One of the clues, though, has been the big rally that we've had more recently over the last couple of weeks. Some calling it a reflex rally within a bear market. Either way, those who have invested with the Fed, the extraordinary liquidity efforts of the Fed, they've been handsomely rewarded. Take a look at that. The S&P 500 up 27% from its March lows. It'll be interesting to see whether or not that continues. Probably much of it will depend on the data that will come out and whether or not the bottom of the U. Most seem to think at this point it will be a U-shaped recovery as opposed to a V. Perhaps it could be more painful. But right now, again, the momentum in the near term is to the upside. That may be why we see the losses declining or lessening, I should say, on the day. When we go to take a look at the land of currencies, the dollar about flat, up just slightly. We have both the CAD and the krona, the oil currencies, taking a bit of a hit on oil. The Kiwi up 0.6% on the news that New Zealand is easing their restrictions in about a week, so that currency responding well. And then finally, just to take a look at a few movers on the day, Guy, it seems that stay-at-home stocks are doing well. Fleur, the thermal camera company, popping sharply higher on the idea that thermal cameras may be used more and more in the future. Alexion Pharmaceuticals popping higher on the announcement of a phase 3 trial for patients with severe COVID-19. And then Netflix and Amazon, they continue to do well. And that is one reason why here in the U.S., Guy, the NASDAQ and the FANG index in particular are higher.
Yep, they're getting more and more heavy with those tech stocks and some of those healthcare stocks. Abigail, thank you very much indeed. Bit of breaking news out of the UK. The daily total gets higher and higher. UK reporting 449 new coronavirus deaths. That takes the total to 16,509. This is Bloomberg. From London, I'm Guy Johnson with Vonnie Quinn over in New York. This is the European close on Bloomberg Markets. Let's turn our attention to what is happening in the UK and elsewhere. We're going to get a Bloomberg First Word News update. Here with the details of that, Ritika Gupta.
Thanks, Guy. The White House and Democratic leaders are close to agreeing on the next coronavirus aid bill. This measure would be for as much as $500 billion. It includes more money for the small business loan program. There's also funding for hospitals and testing. Vice President Mike Pence will discuss testing shortages with governors today. President Trump says some governors are relying strictly on state laboratories. He said that they should turn to large commercial and academic labs as well. Governors of both parties have called for more widespread testing. They say they can't start to reopen the U.S. economy without it. British Prime Minister Boris Johnson is resisting pressure to ease the coronavirus lockdown. Bloomberg's learned that Johnson fears a second wave of the pandemic could hit the UK. Johnson hasn't returned to work after being struck by the virus. And in Germany, the number of coronavirus cases in the last 24 hours rose by the least. This month, the number of fatalities was the lowest since April 1st. This week, Germany will begin allowing smaller shops to resume regular business and schools will gradually reopen. Global News 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy?
Ritika, thanks very much indeed. So, as Ritika was just mentioning, Germany beginning to reopen, Angela Merkel warning that there may be a rise in the number of cases. Prime Minister Boris Johnson in the United Kingdom has decided that actually that second wave risk is too high, and he's very worried about it, and therefore it is likely the UK economy is going to remain on lockdown a little longer. Let's get the latest on what is happening in the UK. We're joined now on the phone by time to come.
Yes, they extended it by 3 weeks last week, and Johnson again seems to be showing these signs that he's concerned about a second wave, and that suggests that when the restrictions are lifted, it's going to take some time. The problem here for the government is these restrictions have brought the UK economy to a near halt. You've seen a surge in furloughs and welfare applications, and as other European countries are lifting some of the restrictions, Britain isn't. The problem they've got is they need now to figure out how to do this, and there's a debate going on in government right now about whether or not how you do a kind of staged lifting of these restrictions or not, or whether you hold put. The risk here, and why the government is so keen to play down any of this debate right now, is that their great concern is if we talk about lifting these restrictions, people will immediately stop obeying them, and we'll see another spike in the virus.
So how much resistance is he actually facing, Ed? Because it seems like this is the debate that happens in every economy that's going through this, and it's probably a wise thing to keep the economy closed.
Correct. I mean, the thing to look at here are the opinion polls, because these restrictions are astonishingly popular. I think one of the polls had it was 90% of the population was in favour of keeping these restrictions. You can see that, given that people are concerned that they or their loved ones may get this virus. Johnson has got a lot of space there to keep these restrictions in place for the time being. That said, there is a risk that the longer he keeps them in place, public opinion turns very, very quickly, and he will not want to get caught out by that.
The possibility of a second economic shock from a hard Brexit is something that now needs to be thought about as well, Ed. And we've got Brexit talks restarting. Having read a lot of the papers over the weekend, there is, though, this fear, particularly amongst the Tory press, the Conservative Party press, that there is a danger that the UK gets sucked into helping the Eurozone out. So we've got a big meeting coming out on Thursday if the UK decides to extend. How finely balanced the decision is this at this point?
It's a very straightforward decision right now for Johnson, and that is and it's very easy to do nothing until June. He doesn't have to decide whether to apply for an extension until then. So for now, the best thing for him to do is to let the talks run on, see if he can get that trade deal, that limited trade deal that he wants with the EU, and if he can get that by June, he would expect him to sign that. I think where it becomes more difficult is if by June the two sides are still as far apart as they always have been. Does he then decide, look, I'm going to need to extend, and the consequence of that would have, of course, having to pay into the EU budget to an unknown extent at this point? Or does he turn around and say, look, the costs of Brexit are going to be relatively small relative to the much, much larger economic costs of the coronavirus, and that then there is therefore a political opportunity to go ahead with effectively a hard form of Brexit while coronavirus is going on. Now, business is pressing very hard for a delay. They don't want that double whammy of Brexit and the coronavirus, but politically you can see a path through that now.
We have to leave it there, Ed. Thank you. That is Edward Evans there reporting for us in Britain. This is Bloomberg. Live from New York, I'm Vonnie Quinn along with Guy Johnson in London, and this is the European close on Bloomberg Markets. Let's get to your latest Bloomberg Business Flash now. It's a look at some of the biggest business stories in the news right now. United Airlines posted a $2.1 billion loss in the first quarter. The coronavirus pandemic essentially halting all air travel. United's revenue is down 17%, and it will get worse, according to the airline. United is expecting a 90% drop in capacity next month. Novartis will run a U.S. study of the malaria drug hydroxychloroquine. The medicine has been hyped as a potential treatment for coronavirus. Novartis is going to test the drug alone and in combination with an antibiotic. And burger chain Shake Shack will return its entire $10 million loan from the U.S. government. The loan's designed for small businesses hurt by the coronavirus. Shake Shack had sales of nearly $600 million last year. Bloomberg has learned that more than a dozen publicly traded companies with revenue over $100 million received loans. And that is your latest Bloomberg Business Flash. Guy.
Maybe a few holes in the system, as John was suggesting to Larry Kudlow a little bit earlier on. Vonnie, European equity markets, as we head towards the end of the day, are in positive territory, though volume, I have to say today, really quite light. This is the story across the pieces you can see for the main markets, the FTSE 100, the DAX, and the CAC 40, all in positive territory. What's interesting, actually, is that oil stocks, while down, are not the lead losing sector here in Europe today. We'll run through the details of what is in just a moment. But in terms of what we're seeing, a light volume session. I suspect everybody's just waiting to see what's going to happen for the rest of the week. It's been quite a run. The US putting back-to-back gains together as we worked around the holiday-shortened weeks. Nevertheless, some positive pictures developing today, at least in terms of some of the stocks that are being built. More of a defensive bias still in terms of the stocks that are being bought up. Anyway, European closes next. We'll deal with the details then. This is Bloomberg.
Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Seconds to go until the end of regular trading in Europe this Monday. Let's take a look at where the action has been. This is what the session has looked like. We've come back this afternoon. Certainly a more positive session this afternoon. As you can see, we're finishing kind of basically at session highs or near session highs we hit first thing this morning. We're up by around 0.5%. Lows hit kind of mid-morning, late after sort of mid-morning into the lunchtime period. And since then, we've really been climbing back as the US has turned around as well. Let's take a look at the individual markets around Europe, because there is a bit of difference. The main markets are generally higher. Some of the peripheral markets are under a little bit more pressure. And you can see that. The FTSE 100 up by 0.2%. The DAX in Germany, stocks like E.ON coming round this afternoon and coming back into positive territory. SAP coming back really quite strongly. And then you take a look at what's happening with the Madrid markets, where you've still got Inditex under pressure, the big global retailer that owns Zara. You've had some of the Spanish banks as well. You saw Santander getting really pummeled once again. The Santander is trading at lows that we haven't sort of seen for many, many decades. And the Spanish banks continue to act as a drag on that market. In terms of the sector breakdown, let me just walk through the numbers there again to give you an idea of what kind of rotation we've seen around Europe. What I think is interesting today, actually, is it's the oil and gas stocks that are actually not the lead losers, despite the fact that we're seeing that huge amount of turbulence over in the United States. But nevertheless, the top end of the market still driven by a more defensive bias in terms of the sector breakdown. So the market's still rotating back into some of those safer stocks with a little bit more visibility. Earnings season starts to kind of get into gear a little bit this week. We've got stocks like Credit Suisse reporting numbers. We'll do that later on this week, but it's more focused on what is happening over in the United States. Just some individual names that are probably worth focusing on. Let me just throw a few of them up. As I say, some of the tech stocks have come back quite nicely. We are seeing SAP, as you can see, only down by 0.2%. It was down much more than that a little bit earlier on. The oil stocks are down, but look, Total over in France only down by 0.6%. And KPN has actually gone kind of a little bit of a bumpy journey today, indicating earlier, this is the Dutch telco, indicating that actually its KPIs aren't really going to be affected, but the market's still dragging that stock down. But we are certainly seeing a turnaround today. Those stocks were most of those stocks were much worse earlier on in the session when I put this board together. And most of them were kind of rotated back up as we've seen the general market coming back as well. But it's been fascinating to see that happen, particularly with some of the tech stocks. Bonnie, what are you seeing over in the States?
Well, it's the same story in the States. Crude oil is providing a bit of a drag to the indices. We're just all absolutely eyes peeled on that crude price, even though it's rolling over tomorrow, and we know, and there's plenty of reasons why it's down there. It's still absolutely eye-popping to see a 10 handle on a barrel of WTI. So we're off our lows for the S&P 500, but there are only two industries that are higher, and that's retailing and pharmaceuticals, interestingly. Retailers are up 0.7% as a group. The dollar index is getting close to 100 again, a strengthening dollar as those oil currencies are pummeled. The Canadian dollar down 0.5% today, and some of the other currencies as well much lower. The Mexican peso is trading down about 1.3%, 24 pesos to the US dollar right now. And the 10-year yield at 64 basis points. Take a quick look inside the S&P 500 for a little graphic description of what I just said. As you can see, just two, barely three industries higher. Guy.
Bonnie, let's turn our attention to what is going to happen later on this week, and the build-up to it is fascinating. Spain is proposing a $1.6 trillion fund to pay for the reconstruction of the European economy through a perpetual EU bond. But that is, as one would expect, running into certain amounts of opposition from the Germans and what is happening out of the Netherlands. Here with more is Bloomberg's Maria Tadeo. Maria, we've got this huge meeting coming up on Thursday. Everybody's trying to set their stalls out in advance of that. But is actually anything moving? Are either side showing any sign of giving ground?
Well, look, it's a huge meeting. You're right. Everyone in Europe, of course, that trades Europe is keeping a very close eye on this because the stakes are very high. You're starting to see really the economic damage of the coronavirus. Just to give you an example, the Bank of Spain today said that in the worst, most stressed out scenario, they see an economic contraction of 13%. But going into the meeting, I think what we're seeing right now in the days prior is a lot of ideas being floated around, and the hope, of course, is that something is going to stick by the time you get to Thursday. Now, the latest one that we've seen, which kind of moves away from this pure form of a Corona bond, is this recovery fund that the Spanish are pitching. It's huge. It's almost the same size of the Italian economy. What's key is what you pointed out. This would be done by tapping the markets and funding a perpetual bond, which some argue is very tricky. And, of course, the obvious question is who is going to buy these bonds. I guess the answer would be the European Central Bank once again. But this is the idea that's being floated. It built up on a proposal by the French government, which said, okay, we'll move away from just a pure Corona bond and we'll focus on the fund. And maybe that's a way to bridge everyone and bring them all in. We just heard from Angela Merkel today saying that she doesn't see Corona bonds, but she has left some leeway saying that Germany will like solidarity and will show solidarity come Thursday.
Look, there doesn't seem to be any moving on the part of the Netherlands or of Germany on the Corona bonds, but what about the bad bank idea, Maria? Could that gain more traction?
Look, this is a story that was reported over the weekend, which suggested that the European Central Bank was floating the idea that there could be one reinitiated so that companies and well, mostly in particular lenders in Europe that could see companies but also clients not being able to service some of their payments, that could then offload this into a bad bank, and that would remove some of the pressure. What we are seeing, however, is that the European Commission is saying that they never really looked into this. That report has been shut down today, but this happens at times where, there's an idea that gets reported, it kind of loses momentum, but ultimately there is something in the works. Officially, having said that, at this point, no one is really putting this as happening or saying there's any kind of confirmation. But as I said, it's the time of the week where prior to a big meeting, you do start to see a lot of leaks and a lot of information just being thrown out to see what the market likes.
Maria, if we don't get any progress this week, if we are still at loggerheads, if we still don't have an ability to find a way through this, the papers across Europe this weekend were full of kind of doomsday scenario about what it's going to mean for the EU and the French president in particular. There was a piece in the FT, an interview he did with the FT, where he really kind of said, this is kind of the EU's moment. If we don't get this right, then this is an existential threat to the Union. Is that what you're hearing in Brussels? Is that how this is being perceived? I don't want to big it up too much, but that's certainly what the press over the weekend seemed to suggest.
Yeah, you're right. And look, that's the way he presented it. He said this is almost make or break. This is a situation that we could have never predicted. Really, it's the future of the Union. I can see why countries like Spain and Italy in 2 years' time could say, why do we want to stay in a union that doesn't really help us? And he also said, because the stakes are so high, it's time to enter really the unknown. And that means doing things we've never done before and kind of breaking old dogmas. What I would say, however, is that, and this I hear in Brussels oftentimes, is that Emmanuel Macron likes to do this. Before a big meeting, he likes to really get with this almost dramatic language to say it really is the future of the state, that's the future of the Union that's at stake, but really it's his position as the French president that he's trying to hype up. What I do hear sometimes is that you need to remove some of that language, you need to take the drama out of it, and actually the situation perhaps is not as bad as it's making it sound to be. So I do hear the two sides. Some that really do say there's a big political risk here. Ultimately, the question that citizens in Spain and Italy, where there has been a huge crisis and hundreds of people dead, ask themselves, did the EU help us? Are we better off? But then also other countries would say, ultimately, we have put a lot of money towards the ECB is buying a lot, and we could explore other options, perhaps not a Corona bond, and put more money on the table. So remove some of that drama, but this is very, very Emmanuel Macron style, I would say.
We're out of time. Maria, thank you for joining us today. That is Bloomberg's Maria Tadeo. Little piece of tape now. The chairman of Societe Generale and former ECB board member Lorenzo Bini Smaghi says most European banks have done enough with their capital from the fallout of the coronavirus pandemic. He spoke with Bloomberg's Francine Lacroix earlier today.
This proposal, I think, affects only a small portion of European banking system that has still higher NPL ratios compared to what is to be considered normal, so only in certain banks and certain countries. So I would not consider this as a systemic package, because most banks have enough capital to address the new wave of NPL which may arise from this crisis.
What exactly is this outbreak? Is it much of a shock politically as it is economically? I mean, is this really a crossroad for Europe? And do we need Corona bonds, or is the ESM enough? It's unclear if this is emotional because people want solidarity at any cost, or whether they really need it economically.
I think it's very difficult at this stage to assess the impact of the crisis on Italy compared to other countries. The IMF estimates indicate that more or less all European countries are affected in the same way, some more than others. I see in Portugal, Greece, but if we look at the development of the pandemic, if we look at countries like Belgium, Spain, I think we are all in the same boat. The point is that the starting situation is different. Italy starts with a higher debt to GDP ratio and a lower growth rate, so it may need stronger support. I think the political issue is more relevant right now than the economic issue, in the sense that there is an issue of trust between the leaders at the European level, and there is an issue of legitimacy of the political leaders with respect to their own domestic public opinion. I think in Italy, a large part of the public opinion has lost some trust vis-à-vis the European institutions for a series of reasons related to immigration, but also to this crisis, which started first in Italy, and they want more. I think that in the scale of wishes, some would like also to go to a true federal system that would guarantee also the Italian debt, but this politically is I guess, too early and cannot happen without a major change in the treaties and a major transfer of sovereignty from the national level to the European level. So this may be more for the medium term rather than for this week.
Should we really also think about splitting government debt with a part of debt forgiveness?
When we look at the debt sustainability throughout the world, I think we tend to underestimate two issues. One is that interest rates are going to be low for very long. I mean, they were already low before the crisis. They're going to be lower even for longer because there will be an excess of savings over investment at the global level. So low interest rates. Second, a large part of this debt, the public debt, will be in the balance sheet of the central bank throughout the world, including in Europe, which means basically that when countries have to refinance themselves, part of this refinancing is taken care by the central bank. So the pressure on interest rates is going to be lower, and I think the debt sustainability will be much improved by this intervention by the central bank. In Europe, the ECB will basically hold 30% of the debt of the member states, which means that even if Italy has a debt to GDP ratio of 160% or more, 30% of that will be in the hands of the ECB, which means that in practice, the debt in the market is going to be around 100%, 110% of GDP. So I think we have to rethink a little bit this concept of sustainability, which is going to be better than what we may think based on simple indicators.
The chairman of Societe Generale, former ECB board member Lorenzo Benismaghi there on Bloomberg earlier. An update for you now on New York virus deaths. They have moved up to 14,347 from yesterday's 13,869. So once again, 14,347 deaths in the last 20. That brings the total number to 14,347. Let's check in now on the First Word News with Ritika Gupta.
Thanks, Bonnie. President Trump's joined those saying a deal is close on the next coronavirus aid deal. Democratic leaders and the White House have been working on the package. It would provide up to $500 billion. More money would go to that loan program for small businesses. There's also funding for hospitals and testing. The nation's top infectious disease expert is warning that moving too quickly to reopen the economy could backfire. Dr. Anthony Fauci tells ABC that unless the U.S. gets the virus outbreak under control, a real economic recovery is not going to happen. Fauci is pushing back against protesters who are ignoring their governor's stay-at-home orders and calling for him to be fired over his guidelines. Another sign that the longest expansion in the U.S. history has come to an end. The Chicago Fed's National Activity Index fell last month. It's now at a level that signals the U.S. is in a recession. Weaker production and employment highlight the impact the coronavirus has had. And Iran is beginning to reopen highways and major shopping centers. Some people say it's too soon and that this could lead to a second wave of infections. Iran has more than 83,000 confirmed cases and 5,200 deaths. Still, Iran's parliament believes the real numbers could be twice that. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Bonnie, Guy.
Ritika, thank you very much indeed. Quick look at where European equities have settled. These are the final numbers here in Europe. A more defensive bias to the makeup of the market today. Most of the main markets were in positive territory, as you can see, but in the UK, for instance, it was names like Unilever, AstraZeneca, Reckitt Benckiser that rose today and added the most points. At the bottom end of the market, Royal Dutch down. We saw BA Systems under pressure, Prudential under a little bit of pressure as well. Over in France, it was Airbus, Veolia, Total, so some of the airline sort of related stocks there, some of the oil related stocks coming under pressure. And again, in the French market, it was the more safe end of the spectrum names that were doing well. Sanofi and L'Oreal both rising today. We're going to continue the coverage at the top of the hour of what is happening specifically here in the UK. The cable taking to the air, John Ferro over in New York. I'll be joining him here in London, and we'll of course take the daily briefing from 10 Downing Street. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Live from New York, I'm Bonnie Quinn along with Guy Johnson in London. This is the European Close on Bloomberg Markets. Let's get to the latest from Washington now as Democrats and the Trump administration work towards a deal that could possibly be as large as $500 billion to help a tapped-out small business aid program and provide money for coronavirus testing and overwhelmed hospitals. Joining us from Washington is Bloomberg's Josh Wingrove. Josh, there's the phase 3.5 and the phase 4, and a lot of figures are being thrown around. What exactly are we talking about is going to happen this week and then will happen later on in the next month or two?
Yeah, I guess there's even 3 pots if you want to think about it that way. This is the deal to top up that PPP program, the small business program, which ran out of money last week, and the Democrats were looking for concessions to be able to do that, because the quickest way to do it is unanimously. So that looks like they're getting a deal on that soon. Although, as of last night, we expected to vote in the Senate today, or at least as early as today, and it's looking less and less likely that that will be the case, but it remains unclear. We don't yet know, what the last sticking points are. And then after that, there's, so-called phase 4 talks, which we sort of don't really have a timeline on. And then, of course, Trump has also called for infrastructure funding, which he views as distinct from that as a sort of, economic action initiative. So this is the sort of zone we're in, but it is at least good news for small businesses, although questions really remain about that program, and in particular, can the smallest of small businesses even get the money, or the bigger small businesses just gobbling it up?
Well, yeah, how did Shake Shack get all the money that it got? Why is it giving it back? And what does that tell us about the current program, Josh?
Yeah, so they've structured it in a way that if you have fewer than 500 employees per location, as opposed to per company, then you qualify. And of course, that opened the door for, Shake Shack and others who have, I assume, pretty sophisticated banking operations to swoop in and grab money, but the mom and pop pub down the street wasn't going to be so lucky. So, it's really unclear right now whether they're going to change that. Larry Kudlow, the White House economic advisor, told Bloomberg TV earlier today that, he thought it was a pretty well-designed program, and he praised Secretary Mnuchin, in the design of it. So it doesn't actually look like there will be a lot of changes, but again, so far unclear. This had been one of the core complaints among Democrats. They said, we're not going to just do a straight top-up of a program that, in their view, isn't working, that isn't getting money easily enough to the smallest of the small businesses.
The idea, though, is to keep jobs, right, Josh? And obviously Shake Shack has access to credit lines and so on, but its employees are like employees of other fast casual restaurants, and they need to either know that they're not coming back to their job or be paid. And part of the problem is that this is only a 2-month scheme. What happens if the economy isn't open after 2 months?
It's a great question, and the answer is we don't know. We also are really continuing to watch how quickly that money can get out the door in terms of the direct-to-individual type money, and folks that don't have, direct deposit stuff set up already might see delays in that. So, this is just the economic side of it. Also, we are still, on the flip side, watching how they're able to mitigate the virus spread so they can move to that reopening. The president today tweeting that testing will be up to the states. Well, if that's the case, then you might want to pump the brakes for expectations, because a nationally coordinated testing program presumably could clear that hurdle more than individual states. So, Fauci warned today, Dr. Fauci, that you can't get back to economic normal until you get a handle on the virus, and, the jury is really still out on that one.
Absolutely. We'll see what happens tomorrow with the vote. Josh, thanks for the update. We greatly appreciate it. Josh Wingrove joining us on the latest out of DC. This is Bloomberg. From London, I'm Guy Johnson with Bonnie Quinn, of course, over in New York. This is the European Global Market, Bloomberg Markets. Time now for a quick Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. Let's kick things off with the auto sector. General Motors and Ford could face multi-billion-dollar losses from a big drop in used car prices. That's according to a note from JP Morgan. Wholesale prices plunged almost 12% in the first 15 days of April, and JP Morgan says the real losers are the automakers' finance arms. The bank estimates that GM could lose $3 billion, Ford $2.8. And another blow for Boeing's grounded 737 MAX jet. A big Chinese lease company, CDB, has cancelled an order for 29 of the jets. The list price, at least $2.9 billion. A growing list of customers scaling back plans for buying the 737 MAX. And that's your Bloomberg Business Flash.
All right, coming up in the United States, Balance of Power with David Weston on Bloomberg Television and Bloomberg Radio. Among his guests today, UPS CEO David Abney. This is Bloomberg.
Yet another day of risk off across the financial markets.
Yeah, let's hope they have a sense of responsibility, even though, I mean, they have a fiduciary responsibility to grow. Danielle, one last thing. I mean, you see restaurant activity all over the world. So we're talking about the White House response here on small business, but is there a government who's doing it better or best?
I'm talking to the French, and I think the French government has different social settings who have already brought different support to individuals. For example, for my employees, we created a foundation to try to support them in their hardship and need right now. And we have done very well thanks to the generosity of many of our customers, our friends, and our business partners. But we kind of took the initiative to support our staff because I think that was very, very important. I don't know. It's difficult if there is any. It's all about their social structure as well. I think it's very different. This week, for example, in order to start to occupy my staff for good cause, I'm reopening my kitchen in New York. Reopening the kitchen to do, is to work with World Central Kitchen and the airport of President Rest. Yeah. It's very important. And also City Meal on Wheels, which I am the co-president in New York City, and we really need support there as well.
Yeah. Well, Chef Daniel Boulud, thank you for joining us. So much more to cover, but unfortunately that is going to do it for us here at Squawk Alley. We are going to send it over to Scott Wapner in the half.
Morgan, thanks. Our breaking news coverage of the markets continues right now. I'm Scott Wapner. Welcome to the Halftime Report. Stocks well off their lows this hour. The major average is now coming off 2 straight weeks of gains. We're watching the big drop in crude, obviously, a couple of big brand name downgrades as well. And in just a few minutes, we're going to be joined by the legendary investor, Howard Marks. We're looking forward to that. First, though, we debate your money with our investment committee. Josh Brown, Jim Leventhal, Steve Weiss, Pete Najarian, Shannon Sakosha is the Chief Investment Officer at Boston Private Wealth. It is good to see all of you, and I hope all of you are well. Let's check the boards today. You can see I mentioned we're off the lows. NASDAQ's green, Russell's green, Dow's only down 160 now. The S&P's down 0.25%. That's down 8 points at 2866. I mentioned crude. I know it's jarring. You look at that number to the right-hand side of your screen, down 43%. Crude sinking more into the abyss today. We do have more big earnings reports out this week as well. We'll discuss all of that. So, Pete, I'm coming to you first. Dow and S&P are on track for the best month since October of 2011. Now we're starting another week. What are you doing in the market today?
You know, it's probably one of my more active days, Scott. As a matter of fact, last Friday when I was on with you, that last 3 hours of the day, it seemed like an opportunity to me because we had the last hour, we moved 300 points in the final hour of trade. And so just to reiterate something we talk about all the time to the downside, Scott, we talk about all the algos and all these other things, you know, the computers and everything else. Well, that was probably what was working us to the upside, I think, on Friday. So when we gave back the 500 early this morning, we really didn't give back the full 500 because of the fact that I think a lot of that was just fluff at the end of the day. So yes, we were down. We still continue to be down. But what I like what we're seeing today, Scott, is we're seeing, and it's a little bit better. It's still part of what we've been seeing, which is the NASDAQ, and the NASDAQ outperforming, particularly when we were down about 2%. The NASDAQ was only down less than 1%. And then as we started to pull back and started to move to the upside, we could all see the NASDAQ actually going into positive territory. So what are we really seeing? We're seeing a little bit of a continuation of what we'd seen, which is still coming after some of those big names in tech. Specifically, if you go down to the semiconductors, I'm seeing a lot of strength and a lot of buying today, and I'll highlight some of that later for you. But the reality is we have seen buying. Even when we started off down 500, very few folks in the derivatives world were coming in looking for puts, looking for that kind of activity to really tell us that they're looking for more downside to continue. Everything was buying calls, buying. Huge sizes across different areas of the marketplace, including some of the financials as well.
All right, so Josh, Pete said we've seen buying. We're well off the lows. The action today, if you're positive the market, has you feeling pretty good, I suppose. Tom Lee says the control overall has shifted to the buyers. He said, and we have written about frequently, stock market recoveries tend to be V-shaped, even if GDP is U, W, or L-shaped. So maybe we need to start having that conversation in the context of, does the stock market reflect the overall economy? And most people are saying no, there's no way the stock market should be where it is when Main Street is where it is. Tom Lee says you can have a V-shaped recovery in stocks, even though Main Street can have a much decidedly different shaped recovery. So where does that leave us as we embark on a fresh week here, where we're likely to get more news about the virus, who knows, good, bad, or otherwise? We're going to get more earnings reports. We've had this big run, 2 straight weeks up for the S&P. Now what?
So Pete's right in terms of the resilience of the markets and the strength of the buyers coming in. And I'll just reiterate that by telling you, at this point in the rally, we now have 40% of S&P 500 names back above their 50-day shorter-term moving average. A month ago, the number was 0. We have only 23% of S&P 500 names above their 200-day. So still less than a quarter of the market is back in what you would consider to be an intermediate-term uptrend. But again, a lot of healing has already happened. The 2 things I'm watching that I think are notable. First is the XRT names. Maybe we ran out of sellers for retailers. There's a lot of resilience there, and I think that's somewhat encouraging. And then the oil patch, this is interesting. The XOP is actually up on the day. That's the producers. There's not enough place to store all the oil we have. And so when you talk to oil people, they're pointing out that front month is not really indicative of the real market. Look at June, et cetera.
That's right.
Which I agree with. Even the MLPs are green right now. So the fact that you can't even find sellers of oil stocks, given what the underlying commodity is doing today, I think that points, it's another piece of evidence toward what Pete said at the top of the show. And so, yeah, I mean, the buyers have continued to prove themselves. The thing that I'm most focused on, as I've said repeatedly on the show, New York new cases dropped. New York deaths rather dropped to under 500 today. That's from over 700 5 days ago. That number continues to improve from where I sit, and of course I'm biased. The New York numbers had to have declined in order for me to feel better and better that we've seen the worst in March, and that is happening. So I'm most hopeful that leads to a speedier opening of the economy. And I'm still mostly concerned of resurgence once we do get that recovery. That's really the main thing that I have my eye on.
So, Shannon, what do we do then in that context? Do we believe in this market? Do we think it's a sucker's rally that's just bound to reverse itself, that there's too much exuberance back in the market now? What are we to do?
I think you need to be careful about where you place your exuberance. So if you look at names that are trading down today, it's names like Macy's and L Brands. Those are companies that should be trading off here. They're, looking for additional capital. They're not well capitalized. So what I'm hoping is that some of the resurgence that we see will benefit those of us who've been looking for high quality names, those that have been looking to improve their portfolios. investors who are looking at companies who are well situated, even if we do get that resurgence that Josh is talking about, that they still have enough capital and enough business savvy and execution to be able to kind of move past that over the next 3 to 6 months. And so I think as long as the exuberance is well placed and we're not bottom fishing, I continue to think that there are opportunities in this market. And I think that investors who are looking at it from a more thoughtful perspective are being rewarded in days like today.
So, Steve Weiss, what do you make, though, of this Tom Lee note about control having now shifted from the sellers to the buyers? An idea that you can have a V-shaped recovery in the stock market even if you don't have a V-shaped recovery in the economy. He says, think of it this way. Businesses are going to seek cost engineering. If we're in a slow GDP growth environment, that is, labor costs is the single highest cost of a business, and thus if GDP is weak, labor costs will be low, thus cost engineering will lead to better margins, thus EPS recoveries will take place in a slower top-line environment. Does that make sense to you in any way?
It makes sense that we could have V-shaped recovery in the market because that's essentially what we've had. I mean, we're back, I would say, near the highs. Josh gave you some statistics which are accurate. So we're seeing that, and the market is a discounting mechanism, so it's always going to move in front of the economy in terms of recovery or declines. We've seen that. So, look, I still don't believe it's a V-shaped recovery in the economy. I think the market has given the economy a lot of credit, some credit it doesn't deserve, for how quickly it's moved. What the market is focusing now, in my opinion, is that you've got massive stimulus, and I forget who said it on the show last week, but stimulus doesn't work, just look at Japan and Europe. Actually, it's exactly where you should look in Japan and Europe, because stimulus has worked there. If you take a look at a 20-year trend, a 10-year trend, a 5-year trend, until 2018, the market was moving higher. Why? Because stimulus. So we're having more stimulus here that's going to be equivalent to up to 50% of GDP of $22 trillion by the time we're done. Of course that's going to have an impact. So that's what the markets look for. So the only thing it comes down to is what's your timing? How long are you willing to wait until we see the economy start to show signs? I believe we're going to open up the economy perhaps sooner than we should, worried about a relapse, but we should open it. We could sit here and we still work, we're managing money, but for most of America, they're in a very, very tough spot. They need the income. So we'll see that. So the market's also looking at that. I'm not doing, Pete said he's active. I'm not active at all today. Haven't done anything today. Friday, I did a little bit, but I really sold into it. I'm very comfortable with my exposure, which is more than normal that I would have over the last number of years. And I'm about 80–85% in tech. And tech, I'm diversified across, but that's going to continue to work. I can't decide. I don't want to look at P and say, okay, people are shitting more now because the masks are catching to their beards. Is that going to sustain, or how much more soup are they going to buy? I don't want to get into that. I don't know. I'm looking at where the business models are in great shape.
Right.
The balance sheets are in great shape, and it'll continue.
So Pete, you said, Jim Lebenthal, I'll get to you in just a second, but I want to get back to Pete real quick. As active as you are, Pete, I want to know where. I want to know what you're doing today. I know our viewers do as well.
Well, Friday into the afternoon, I sold a lot of different things, Scott, and not because I hated the stocks. Nothing changed about my sentiment. It was just that a lot of them were hitting the right triggers. Gilead's a great example of that. I got out of Gilead. I got out of Netflix. I got out of LQD. I got out of multiple different names. But then today, when the market's down 300 points-ish, so not too terribly far from where we are, but a little bit lower, I thought I saw all kinds of opportunity. I don't want to give away the unusual option activity to you, but I'll give you one that's not there, Square. We had some huge buying in Square. So that's one of the names that I added. And across the board, most of them today were in technology-type names, semiconductor-type names. But I think I'll wait till later on for the unusual. But give or take, Scott, that is the area where I was seeing the most activity and where I wanted to jump on. And that's, quite honestly, as I looked through the unusual activity side, yes, there was some financials, and I'll give you one, the XLF. Somebody bought 25,000 calls in the XLF today in one single print. So when I say there's some bullish paper out there, there is some bullish paper out there. I bought some of those. That's not going to be my unusual, obviously. So I've found more and more opportunities today. Specifically today, I've probably traded more today this morning than I have in the last week in the first 3 hours of the day. So a busy day, a lot of different areas, but primarily, to Josh's point, technology related and semiconductor related were the names that I was going with.
Gotcha. Okay. Now we go to Mr. 10%. He's sitting in 10% cash. It's Jim Leventhal. Jimmy, it's good to see you. All right. I mean, I'm just going to ask you,
too,
sort of
Scotty.
every week, you know, where your head is as to where the market is. There was, you know, if you look at crude oil today, you could have said, wow, this market's going to be down big. And, you know, the Dow is down 500. It's battling back. Where's your psyche right now?
Well, I mean, if I'm generous with myself, I say I'm being boring by not doing anything. If I'm realistic, I say I'm wrong, right, by holding that 10% cash. So I've got to look at myself in the mirror and say, what do I believe? Common sense is telling me that we're not done with this bear market. If we were done with this bear market, if we don't get a 10% retracement, which I expect, this will be the shortest bear market in history, shorter than '87, which was 3 months from peak to trough and didn't even include a recession. So common sense on that front tells me we're not done. Common sense on the perspective of social distancing tells me we're not done, because even as we reopen, we're gonna keep at least 6 feet away from each other. That's gonna hurt airlines, it's gonna hurt hotels, casinos, restaurants, sporting venues, everything. So I don't think we're out of this yet. I think the stimulus keeps us from testing the lows, but I'll be more interesting when the S&P is down in the 2,500s. I know that makes me boring right now and arguably wrong, but I'm gonna stick with that mantra for now.
What do you need to see before you start putting that money to work?
Well, a little bit of realism in terms of what earnings are looking like. So we still have S&P 500 earnings estimates above 150 or right at 150 for this year. I don't think that's right. I think this year you're looking at a 125 or lower. So I'm waiting to see analyst estimates come down as we go through this earnings season. I think you're also going to see more reserves piling up, loss reserves, that is, in the financial sector. So, you know, patience is a virtue, but man, it makes me look boring right now. And as I said, arguably wrong, but you know, I just think there's more bad news to come.
So you're saying, I mean, look, by that logic, and that's fine. Obviously, your point of view and is going to shape what you do. So you may be sitting on the sidelines for months and months and months and months, because you're not going to have, most likely, any realistic view on what earnings could potentially be for many months. We're in the earnings abyss right now, and next quarter is likely to be an earnings abyss as well. There's a lack of visibility. I don't see that getting anywhere towards clarity anytime soon. If you start thinking about normalized earnings, you have to put 2021 in the conversation, and some have suggested on this program that you may have to go out even further than that. So you may be sitting on your hands for an awfully long time if that is in fact what you're waiting for.
Scott, all I can say is ugh to myself, but, you know, just back to the estimates, and you're right? There's no clarity on it, but estimates for S&P 500 earnings for 2021 are above $170, which would indicate that the analyst community thinks we're going to be better than ever in 2021. I just don't buy it. Now, you say I could be sitting on my hands for months. You're right, but I don't think so. I think that as we go through the next 2-3 weeks of these earnings, that some, what I'll call realism, is going to set in. I have to be clear. I don't think we go back to the lows, because you'd have to really be fighting the Fed, which is a bad idea, if you think you're going back to the lows. But a 10% decline is very routine in a bear market. Very routine. You get a bear market rally, you retrace 10%. So 25.50. I mean, I think at that point in time, I've got to just say whatever the environment looks like, I need to step up to the plate at that point in time and buy.
All right, I understand. Let's bring in our special guest then for today. Howard Marks is the Oaktree co-chairman. He is with us by phone. Howard, welcome back. I hope you, your family are well, safe and healthy.
Thank you. Thank you, Scott. It's nice to be on with you. Bring some regularity.
Yeah, it does feel like some semblance of that, and that's a good thing for the moment. I want to talk about your latest memo, but before I do that, I want to talk about your previous memo, because it contained a line that I think certainly it got a lot of play the day that you put it out, and it was the line, "I no longer feel defense should be favored." Can you expand on that and talk about exactly what you were talking about and whether that was your call that the bottom? Let's talk stocks first. Now, I know your credit is your thing, and we're going to talk about that. But were you making a broader call on where we were?
Well, I think the important thing is that it's not healthy or helpful for people like me to say buy or sell. It has to be what you should do. Has to be a function of where you are now and where you have been. And so what I was saying is that, as you know, because I've been with you several times, I've been very defensive in recent years. And what I'm saying is, now that the cat's out of the bag, we know what the catalyst for bad time is, that asset prices are lower, prospective returns are higher. Most people aren't engaged in risky behavior. Those were my complaints leading up to this. I don't think you have to be as defensive as I was.
Now, are you saying that that's from an equity standpoint as well as a credit standpoint? I mean, the credit markets, had become dislocated to some respect. And we've had people who deal in distressed credit on this desk and certainly are finding opportunities. Can you differentiate between the two asset classes and tell us how you're thinking about each?
Sure, Scott. Well, first of all, the comment was a general comment as to overall portfolio construction. It wasn't specific to an asset class. In general, however, I agree that there have been and are very good opportunities in credit, although, like everything else, less than they were in mid-March. In general, I'm less constructive about equity than I am about credit. I was listening to your previous guest, and I found myself very much in agreement. First of all, to the extent that earnings estimates are now, for the S&P, are now 150, I believe that last year it was 158, so that means earnings down 5%. With all the businesses closed that we know about, is it possible that earnings will only be down 5% in 2020? Seems unlikely. And then if you get to 170 next year for S&P earnings, that means better than 19, as he said. Will next year be the greatest of all time? Hard to believe.
Seems hard to believe. Do you think the stock market is ahead of itself right now? Are you surprised where we are?
Yeah, I personally think so. I mean, we're only down 15% from the all-time high of February 19th.